Now, as we know, Toyota is known for all sorts of vehicles. They were founded in 1937, and this company has been just around for many years. This company makes really good and reliable cars, and that's what they're known for. They're similar to Honda in the way that they make very good and reliable cars, and so a lot of people in the general population like to buy their cars because they're not too expensive and they're also quite reliable. So this goes for a lot of their vehicles as well. The hybrid vehicles are also known to be very reliable. The company is done very well with making these hybrid vehicles, and they've had them going for quite a long period of time. The Prius was developed really, I think, in 1997 or 1998. The Prius, for example, was way ahead of its time. So it had a lot of fancy features. So, for example, for the second gen Prius, that second gen Prius actually has Bluetooth, a backup camera, keyless entry, and all sorts of very neat features that come in a base model Prius. So this is something that definitely is pretty interesting, and not the Bluetooth doesn't come in the base model necessarily, but the point is that the company still does very well for not at least not marking up their cars too much so that they're not affordable. And so compared to let's say Tesla, people can go and buy a Prius or another hybrid vehicle or even a tech vehicle or maybe a completely electric vehicle from Toyota and understand that it's going to be a reliable vehicle and also it'll be a car that is going to be full of features and not too expensive. So I think that this is something that Toyota has over other vehicles. I consider this company to be one of the more innovative car companies. In fact, I consider Toyota to be second to Tesla in how innovative they are in developing electric vehicles. Now, here's the deal with the intrinsic value of the stock. We consider that the company currently has, based off of the projected free cash flow model, the intrinsic value is $111 a share. Now, this is below the company's current trading value of $175 a share, which would suggest that the company is undervalued. However, this is not a very good way of calculating the intrinsic value for this company specifically. So the company still has plenty of assets to support the company's trading value, so it's got high stockholders' equity, but the company's free cash flow is negative. Now, this could just be that the information is not given correctly on this website here, Guru Focus, which we have linked in the description below. But unfortunately, I don't find this intrinsic value to be exactly accurate. This company has a book value of currently $156.84 a share. So this is well above the company's current intrinsic value, and this is close to the company's trading value. With a really high book value at around $150 a share compared to the trading value of $175 a share, that would suggest that the company, for a car company specifically, is likely at least fair valued because the company's book value is so close. With a higher book value, this helps to increase and hold the intrinsic value because if the intrinsic value is calculated based off the earnings and also the book value, if the intrinsic value fluctuates even dramatically, then the company's book value will support the intrinsic value and help to at least prevent a dramatic decline below the company's value. So this is very important, and I think that with the company having a higher book value, this will help to decrease volatility and also help to sustain growth for the company's trading value in the long term. Now, based off of the company's current assets, the company's shareholder equity has been increasing year over year. And so this is really nice. The company currently has a shareholder equity of $227 billion. The shareholder equity is actually the assets minus the debt of the company. So since this company has currently quite a bit of assets, despite the fact that the company's debt has been increasing, the debt has not been increasing as fast as the assets. So the assets have actually been increasing faster than the debt. Therefore, the shareholder equity increases. So this is very important. When the company's shareholder equity increases, since the book value is the shareholder equity divided by the outstanding shares in the market, as the shareholder equity increases, this helps to increase the book value. This helps to also increase the intrinsic value, which then in turn helps to increase the trading value. Now, of course, if someone is issuing more shares, if the outstanding shares increase, then that can change things, and that may not allow the book value to increase when the shareholder equity increases. However, fortunately for us, Toyota is actually buying back their own stock, which we'll talk about in a moment. We can take a look at the company's net income, and we consider that the company currently brings in about $8 billion every quarter. Now, that's a lot of money. So the company really does end up bringing in maybe about $24, $25 billion every year, which is plenty of money. This is net income, so this is after paying taxes and workers and fees or anything like that. This is simply the amount of money that the company is bringing in now. So this is definitely something that I want to take a look at and show you that the company really does make plenty of money. So therefore, we can also take a look at the price to earnings, and we can see that the company's price to earnings is currently at about 9 or 10. So with that in mind, this is because the company's earnings have gone up dramatically this year, and so despite the company's current trading value increasing dramatically, the company actually does have a really low price to earnings. It consistently trades at a low price to earnings as well. This is not uncommon for the company to trade at a price to earnings of around 9. They've done this in the past. Even we can look back in 2015, 2014, all that kind of stuff. The company is still very commonly trading at a low price to earnings. So at some point that may change, however, the company has not changed that price to earnings in quite a long period of time, so I doubt it will change anytime soon. So the company currently has an earnings per share that's pretty high, and I can't predict exactly what's going to happen with this company, but from a value investor's perspective, currently the company has a price to earnings that is low, and so if you think the company's earnings are going to drop in the next year, then essentially you would expect the company's trading value to drop, and it will likely follow the price to earnings. So I'd really say that the company's value is based off of primarily this price to earnings at this point, and not really the book value, and certainly not the intrinsic value. We can also look at the outstanding shares in the market, and we can see that the company has been decreasing the outstanding shares in the market consistently and very often. So this company has been buying back their own stock a lot. They recently decided to offer a new buyback program, and this is where they are now able to start repurchasing their own stock at a relatively quick rate. Now, the company has been willing to buy back its own stock a lot recently, which we can see here based off the outstanding shares in the market decreasing. We can see that the company is currently it's gone from 1.6 billion outstanding shares in the market to about 1.4 billion. This is because the company is once again buying back their own stock. They have recently been doing this, and so this has allowed the company's outstanding shares to decrease, which helps to in turn increase the book value and also increase the trading value. So this is very important when a company buys back their own stock. They're decreasing the outstanding shares. This allows the assets to be distributed across less shares. So if there's less shareholders, likely the assets are going to be distributed across less people, and so this is allowing the company's shares to be worth more. So that's very important, and this company has been definitely willing to do that recently. Now, currently, we can see that this company also offers a semi-annual dividend. They offer essentially a 2.4% dividend, so that's not very high, but for the car industry, that is pretty reasonable. And so at this point, the company is offering it the 2.4% dividend yield, and they offered $2.18 in the most recent dividend payment. Now, this is after the company has made a lot of money, so that's why the company's dividend is actually very high for the moment. So that's something that we should definitely take a note of, that the company has paid more money than they have in the past because it's really based off a percentage of the growth of the earnings. And so therefore, with the company having made more money, they're paying out a higher dividend. Now, if the earnings all of a sudden drop, then they will pay a lower dividend. So just be prepared to understand that the company's dividend may really be more around 2% instead of 2.4%, and that they just paid out a lot of money recently, just due to the fact that the company's made a lot of money recently. So definitely keep that in mind. In the long term, though, I do expect this company to be able to consistently make more and more money. They should be pretty inflation protected too, as they are able to consistently increase their pricing of their cars just if they need to, and people still need cars, they still need transportation, and Toyota offers a viable option to the average common consumer who would like to buy a vehicle. So this is very important, and I think that Toyota is going to do very well in the long term for that reason. With them offering good, reliable cars, they also have been able to at least consistently grow in earnings at a relatively slow pace, but the company has been at least bringing in plenty of money. So I think their dividend is going to be safe, and so for a dividend stock, this might be nice. However, I think there's better dividend stocks, but